Do you think the banks, the stocks are also priced for that scenario, or is there an opportunity there?
I think the banks, good morning, by the way. I think the banks are oversold here. Look, at the end of the day, if we can avoid a recession in the U.S., even though we have higher gas prices, I think the banks are oversold here. At the end of the day, there's really, two factors that we have to consider that's the impact of inflation. One, obviously rising rates, and banks are more rate sensitive than they've ever been. They have 50 cents of loans for every dollar of deposits. And second, if you look at the regulatory data, the banks are seeing pretty good loan growth across the board from the end of the year.
And we are seeing a little bit of, unsettled action in the credit markets, in the public credit markets. Does that not mean that, banks are going to feel a little bit of a pressure on the credit side, especially if the economy slows down?
So that's a really good question. So let's dissect that into a couple of parts. Number one, clearly with higher gas prices, our concern is the lower end consumer. So again, even if we avoid a full-scale recession in the U.S., we would see credit card charge-offs normalizing, right? And so that would hit earnings power. But at the end of the day, I think that banks, because they were so heavily regulated and de-risked so much out of the global financial crisis, I don't think the corporate credit quality at the banks is something to be worried about right now. So a couple of things. Again, if we could avoid a full-scale recession in the U.S., I think the debt service coverage at the banks could very much withstand, let's say 250 basis points higher short rates.
Erika, it's Morgan. Just to take a step back, as we are talking about and investors are parsing through slowing economic growth here in the U.S., you are seeing the risk of recession rise based on some strategists' note, including Goldman last night. What are the key metrics you would be watching for, especially in the coming weeks as we do get to earnings, to sort of know from the banks, which are seen as early indicators, whether we are indeed moving closer to a recession?
Yeah, so a couple of things. Number one, we are seeing loan growth, right? And the big question for the banks is that for greater working capital? Is that for inventory? Or are those really similar to some of the defensive draws that we saw during the pandemic, right? Because that would indicate that the corporates are starting to, feel a little bit nervous about the economy. In terms of the bank's indicators themselves, we would, of course, look at early stage delinquencies, particularly in card. Again, higher gas prices are going to hit the consumer first. So if that's starting to tick up, that's certainly something that we should watch.
Shepard Smith here. Thanks for watching CNBC on YouTube.